A lot of assumptions that it seems like we've had about the markets have really been challenged in the last year or two since the Fed's gone on this tightening cycle. And so a lot of things, maybe biases or just historical assumptions that people make, such as, well, when the risk-free rate goes up, the stocks have to be repriced down, but they haven't been. When mortgage rates go up so high, home prices have to come down, but they haven't been. So it seems like a lot of assumptions have been challenged here. And so I guess the bigger question is, if we're in this period where the Fed is fiscal dominance, they're really driving markets, we're seeing assumptions being challenged, then the big challenge is, do the markets have to crash?
So it's a good question. My base case has been range bound for a lot of different assets, which basically points towards not very good real returns over, say, a 5+ year period, but not necessarily expecting a crash either. So I've neither been kind of a melt up bull or a deflationary crash bear. I've been more in that range bound camp, which so far has been working out both in the housing market in aggregate and the stock market in aggregate. Obviously, there are very different industries that can be up or down. There are very different geographies that can be up or down. But overall, that's kind of the general path we've been on. And if we look back historically, I kind of classify the long-term debt cycle, Ray Dalio's work, for example, and then additional work I put into it to kind of really flesh out and explore this concept. I know you've covered it quite a bit as well. It's basically the observation that you go through a number of normal business cycles, but you build up instability in the system a couple different ways, including on the public debt side. And so if we characterize the past 40 years, we had ever rising public debt. So whenever we had a recession, we would have interest rates get cut. That allows higher debt levels, and you get lower lows and lower highs in interest rates, and higher highs and higher lows in both private sector and public sector debts as a percentage of GDP. And that coincided with basically the peace dividend, the opening up of the world. China opened up to the world in the 1980s. Soviet Union fell in the early 90s. And so we kind of entered this more connected world for a period of time. And we basically brought Western capital together with Eastern labor and resources. And that was a very kind of productive disinflationary time. Some people were hurt by it, but a lot of people were helped by it. And that's kind of been the era we've been in, and that allowed for lower interest rates. And when you look at the government expenditure, if you have higher and higher debt to GDP but lower and lower interest rates, your overall interest expense remains manageable. Um, and when we had the global financial crisis, a lot of things changed there. We had a bank recapitalization. We hit the peak in terms of private debt relative to GDP, but we pushed a lot of that debt onto the public sector in multiple countries, especially the United States. And so when we look back at prior long-term debt cycles, they do tend to come in a one-two punch. First, you have the private debt bubble kind of break apart, which is disinflationary. But then the second stage is when all that gets pushed up to the public sector, and then that becomes more of an inflationary type of crisis. Kind of ever since the past, call it 3-4 years, we've been in that second phase of the bubble. And so I think that's one of the best ways to look at it from a historical lens. But then, of course, you have to think, okay, what is different now in terms of culture, in terms of technology, in terms of just the way the world looks? What is different, even though that's a useful baseline. And it's, these types of periods are always weird. And so there's going to be challenging things to navigate that you didn't necessarily expect, which is why it's useful to have a framework, but to also be very flexible with your thinking to see what sort of curveballs might or may not come, and then, adjust that over time based on what's happening.